What do I mean by face of the bond? It's on the face, right? It's on the piece of paper. Where did it say the face amount? On the piece of paper. It says who's borrowing the money, right? Maybe, right? But it's for sure going to say, always says who's borrowing the money. Maybe it'll say who's lending the money. Usually not, though, because you could buy a bond and sell it to him, and he could sell it to him, right? So they don't care who they owe the money to. They're just going to pay whoever's holding your bond, huh? That makes sense? And it says what else on the face of the bond? The amount of the bond, and what else? The interest rate, you bet. And that, what is that? Is that the stated rate or effective or yield rate? What do you think? You read about that stuff. That's a little confusing at first. What's the stated rate? It's printed on a bond. It determines how much interest is paid. So let's say it's a $100,000 bond. 10% interest, semi-annual. What do we got? A $100,000 bond, 10% interest, stated, printed on the bond. How much interest is going to be paid every year on the $100,000 bond? You know, 10% of 100,000 would be 10 grand, wouldn't it? But it's semi-annual, so what will happen? So you give them half of it. So 5,000 twice a year, and most bonds are semi-annual, so we'll do semi-annual ones, okay? But there could be annual ones, there could be quarterly ones, whatever you want, right? Design anything you want. But most are semi-annual. That's how the interest is paid. Okay? So what we'll do is we'll take that stated rate divided by 2 if it's semi-annual. Sound good? And then also printed on the face of the bond will be the term. What if it's a 10-year bond? I'm going to pay interest for 10 years, and at the end of the 10 years, I'm going to pay off the bond. That's all it is, right? It'll be right on the face of the bond, printed there. Okay? Guess what, though? If it's semi-annual, that's not 10 periods. What is it? How many semi-annual periods is it? 20. Okay. Now, the only other thing is the market or effective or yield rate. They all mean the same thing. What does the market want? Or what's the effective rate that you're paying when you borrow the money, or that you're earning if you invest in it, right? Investment in the bond, I get the interest, right? If I issue the bond, right, I sell the bond to somebody, I borrow the money, right? I'm going to pay the interest, okay? What's the effective or yield rate going to do for us? It's going to tell us how much you're really going to earn or how much you're really going to pay. You're still going to pay that $5,000, a little example we did every 6 months, right? But your interest expense isn't going to be that because there'll be a discount or a premium. Now, why do we do this nonsense with an effective rate and a stated rate? Here's the deal. Listen to this carefully, because otherwise it seems really crazy. We want to print the bond once, and then that bond can be sold from person to person to person to person at all kinds of different times, and we never have to print it again. After I print the bond and I borrow the money, I don't care if you sell it again. Why would I do anything? Well, I'm not going to print a new bond with a new interest rate, whatever it happens to be. Plus, the interest rate's changing constantly. Right now, on bonds, interest rates are changing as expectations of future interest rates are changing. Okay? It's the market that's determining what the rate is. You got the idea of this thing? So I want to print these bonds and then forget about them. They're done. I'm just going to pay the stated interest rate, and I'm going to pay off the face amount at the end. And you guys can trade them all you want. I don't care. It's great. Okay? Got the idea? So we have to separate them because we're constantly calculating what the bond is worth. I know you can look up you go out on Yahoo, look up a bond, right, what it's selling for. You could go to the Wall Street Journal and look it up, any service, right? You could go look up what the bonds are selling for, okay? They're trading right now. You can look up what they're selling for, but how do people who are buying and selling them determine what they're willing to buy it for and sell it for? And how much they're willing to invest, and therefore loan, right? What's the deal with this? It's based on what interest rates are currently. It's a moving target. Got the idea, guys? So that's why we do that, okay? So it makes a little complexity. Get here early, don't we? Sorry, guys. All right, so let's try a new one. All right. So let's do a bond. Let's say we have let's say on the face of the bond, huh? Let's make it a simple one. Let's make it a $100,000 bond. That's what's going to be paid at the end. Let's make it 10 years. You guys are going to need your present value tables, right? Let's make it semi-annual. Let's make it 8% interest. Now that's the stated rate, right? Okay. And then let's say we have an effective rate, which is also the yield rate, which is also the market rate, okay? And let's make it 10%, okay? Now, that's not printed on the bond. That's just, let's say that's what it happens to be out in the market right now, okay? When we printed up the bond, we thought 8% was going to be our appropriate interest rate, and the market's telling us, no, we want 10. You either expect inflation's gone up, so people want more interest, right, because of that, or, you know, maybe, that's terrible. Why is that? Okay, anyway, expected inflation is up, or we're riskier. The market thinks we're riskier than we thought we were going to be, right? So they want more interest, okay? That's all it is. Okay, so the market wants 10%. How many people want this bond? We're going to pay them 8% interest in cash. How many people are going to give us $100,000 for a bond that's only going to give us 8%, give them 8% interest when they expect to earn 10? Absolutely nobody on earth. So what are we going to have to do to issue our bond, borrow money? Lower its price. And we got to keep it discounted, absolutely, that's it. So if the effective rate is more, right, than the stated rate on the bond, nobody wants it and we have to discount it. How long do we have to discount it? Until they earn what? 10%. That's it, okay? Now this is semi-annual, gang, so if it's semi-annual, how many periods is it really? How many periods? That's 20 periods, right? Everybody agree with that? We're going to discount it for 20 periods, okay? Because it's semi-annual. Everybody got it? Okay, if it's 8% interest stated, what really interest rate is that? Semi-annual, how much? 4%. So I'm going to discount it, or I'm sorry, I'm going to pay 4%. That's paying, right? By the way, how much interest are we paying a year on this thing? 100,000, 8%. What is it? $8,000. What if we pay semi-annually because it's semi-annual? 4,000. Just let this be common sense, huh? Because it is. Okay? What about my discount rate? It says 10%, but what's that really, guys? It's semi-annual. 5%. You're going to discount it 5%. Okay? Let's value it. There's just nothing to this. There really isn't. No problem whatsoever. Okay? How much cash flows are going to be? At the end, how much? I have a future value of how much. By the way, when is it? When am I going to pay it off? In 10 years, which is how many semi-annual periods? 20. Just by convention, we use the same for the interest and for the principal. So I'm going to have a future value of 100,000 20 periods from now. Does everybody agree with that? Can you calculate the present value of that thing? Of course you can. You know how to do that, don't you? Okay? So it's going to be times what? A present value of a sum factor, right? Interest rate equals what? What's my discount rate? Now be careful. Don't discount it at the rate that you're paying. If you do, you'll get the face value to get back to the 100. You have interest of 4% and you discount it at 4%, guess what? Sell for the 100, won't it? Okay? Sell for the face. Okay, so what are we going to use? This 5% down here, right? Interest rate's 5%. Number of periods, guys? We already said it's 20, didn't we? You know how to do this. So that's 1 over 1.05 raised to the 20th, and you could look up that factor, couldn't you? And that's going to be a present value at times 0. We just did that stuff. What is the factor? 5%, 20 periods, gang. What's your factor? Present value of a sum, right? Because it's 100,000 once at the end, right, everybody? How much is that?
0.3769.
3769. Each dollar is only worth 38 cents right now, right, guys? I would be willing to pay $37,690 if I want to earn 5% just for the principal I'm going to receive at the end, right? So it's worth it. And I'll earn the difference in interest, won't I? Everybody knows this, don't you? I know you do. Not well, but you're getting there. By the end of the course, you're going to be there, okay? You have this wire. It's going to be really valuable for your career, no kidding. It's going to be valuable for other classes you're going to take soon, okay? All right. Then what else do we have? We got an annuity payment, don't we? And it's ordinary. It's at the end of the period, right? What's the ordinary annuity payment? How much interest is there, guys? 4% of 100,000, isn't it? Everybody agree? It's $4,000 20 times. I'm valuing $80,000, aren't you? It's $4,000 annuity payment. And of course, there's 20 payments. So 20 payments at 4,000, of course, is 800,000. Whoops, is $80,000. Okay, it's 80,000 of interest over the term. That's the cash interest, right? It's not going to be the interest expense. Interest expense is based on 5%, 10% a year, 5% semi-annually. Okay, so this is going to be what? This is going to be an annuity factor, present value of an ordinary annuity, right? What's the interest rate, of course? Still 5%, isn't it? What's the number of periods, of course? Still 20. There's 20 payments. Yeah, great. What is the factor on the present value of an ordinary annuity table? 20 periods, 5%. What is it, everybody?
12.4622.
Okay, excellent. What's worth $12.46? $20. Receive $1 at the end of each period for 20 periods. All discounted at 5% per period, right? You know this stuff, okay? So what's 12.4622 times 4,000? What's really cool about this is you know it now, and you're going to be able to use it by the end of the semester, which is what, 5 weeks from now? Really, I'm not kidding. How it happens. Those of you that are sitting here are working. I wouldn't be sitting here still. Look at all the empty chairs. Okay, I don't like all the empty chairs. I wish everybody worked like you guys do. Okay, just keep going, like pushing. You want to know this stuff, okay? I know you don't know why you want to know it yet. It's hard, right? But I know you really want to know it. Okay, I never like to give students anything they're not going to use. I hated that. What's really sad is your history class, your philosophy class, need it. And that's really hard to see, isn't it? Oh my gosh, what am I going to ever do with that? Trust me. Trust the teacher you've got. 4,000 times 12.4622, how much is that worth?
49848.8.
4984801.
801.
Can we make it one? About. Is that what it was? You said 498,488.
Point.
Oh, it's not 498,000. I don't have $1 million there. I apologize. That's a little big. The mistakes I tell you guys not to make, right?
848.
848. Okay, good. That it? Thank you, sir. Okay, so what's worth that? 80,000 of interest, right? The payments of interest. Add the two together, it's what the whole bond's worth. Would you agree with that? That's it. How much is that? You guys aren't helping.
87538.
Is that selling for a discount or premium? It's less than 100. Come on, it's a discount, right? That's easy, isn't it? That's the cash you're going to get. Everybody agree? See what we're doing? Okay, now what interest rate are you going to earn? 4% or 5% here, you guys? 5. You discounted at 5. We are going to unravel it and then amortize, therefore, at 5. Okay? Now, why did this come up less than 100? Because the effective rate of 5% per period, 10% a year, is more than the 4, right? You got it? Or 8% per year. Everybody agree with that? What if the market rate had been 7%? Everybody loved this bond that pays 8, and we'd all bid on it, and we'd bid the price up, and it'd sell for a premium, and we can compute what the premium will be, right? What's the discount here, you suppose? You know, you're getting $87,500 for it, you guys. You're going to pay 100 at the end. What's the discount? The difference. That's it. Okay? All right, so let's do the journal entries. Let's do the journal entries on both sides. Okay? Guess what? One side is going to be the borrower, and the borrower is also the issuer. I issue the bonds, I borrow the money. And it's also, if you want to think about it that way, the seller. We could call them any of those things. It's the same folks, okay? The company that's issuing the bonds, borrowing the money, is selling the bond, okay? Got it? Just terminology, business terminology. So anybody that says that will know what it is. By the way, it's really good to know what bonds are. Stocks and bonds, you know, kind of important. We're going to do stocks too before we're done, okay? And kind of big time. Okay? Then what? What's the other side? If one's a borrower, I bet the other side's a lender. What do you bet? If they're an issuer, what are they? Purchaser, maybe, right? I guess seller is purchaser, so maybe issuer is investor. the terms lined up. It doesn't matter. You don't have to remember them that way. But just to give you the idea, right? So lender is also the investor. That's what we usually call them. You're investing in bonds. We're going to call it an investment in bonds, okay? And then they're also, if one side, the seller, they're, I guess, the purchaser. Got the idea? Okay. Lender, investor, purchaser. Okay. I'm going to call it investment in bonds. If I'm issuing the bond, I'm going to call it a bond payable, right? If I'm buying the bond, I'm going to call it investment in bonds. Okay. So what happens to, let's say this bond is dated January 1st, year 1, okay? Whatever that is. Okay, January 1st, year 1. What would happen on January 1st, year 1? By the way, it gets more complex if you do it after the first day of the year, because they can be sold anytime, right? We'll worry about that in a later class, okay? Much later. Those who become accountants when this went out. Okay, so what do we do here? How much cash changed hands? Don't think about it too much. We just valued it. 87,538. That's what's going to be paid for it. So if I borrow money, guess what? I get cash, debit cash. Don't you think? How about if I invest the money? What happens to me? Credit cash. Before you guys started this class, you did not know that. You give yourself some credit, right? I know you know things. By the way, on the final, that'll be on there. What does debit mean? What does credit mean? Okay? It's in the class. You learned it this semester. You get credit for it, right? Okay, it's okay. So about a third of the exam will probably be that first test, huh? But feel good now, wouldn't it? Right? What you know now. It will feel good. So will the second one by then. Okay, what would we do if we're the borrower? We borrowed money. What are we going to call it? Bond payable? That's it. No kidding. Now we're going to put this in at face. Just by convention, we put it in at the face amount. The full amount we're going to pay at the end. How much is that? $100,000. And then we have a difference of 12,462. Is that what that is? You got to make your journal entry balance. What's that? Not yet. It's going to be interest expense later. You're right, because we're going to pay him back 100, and we only got 87,538. I'm not going to pay him back 100. I'm going to pay him back 180. Aren't you? 80 of interest payments in cash plus 100 face value. We're going to pay off 180 on this thing, and we only got 87,000. What's my interest in total going to be? I'm going to pay. Everybody agree we're going to pay him back $180,000? We are, aren't we? That's the 100,000 face amount plus 4,000 interest 20 times. It's 180 grand, isn't it? Okay? So 180,000 I'm going to give them back. Everybody agree? They only gave me $87,000. How much interest total is there? What's the difference? What's that? 92,462. Oh, 92,462. It's the 80,000 cash plus the 12,462, which is additional interest. You're absolutely right, except it's not interest expense yet because no time went by. So what is it? It's it's a reduction of the payable for now, called, discount on bonds payable. You got it. And once you see that, you got this made, you guys. That's all it is. What's the carrying value of the bond, of course? It's 100,000 less 12,462. How much did we really borrow? 87,538. On my balance sheet, I'm going to show a bond payable of 100 less the discount of 12,462. It is a contra liability account. Got it? And the net liability is the difference. It's just like equipment less accumulated depreciation on the asset side. Got it? Works exactly the same way. Everybody good? It's a little easier in a way on the investor side. What do? We don't put it in at face amount. We put it in at whatever we paid for it. We don't really care what the face amount is. Okay? Because we're not paying the face amount at the end. We might not even hold it the whole time. You might buy it and then sell it to her and him to her. Got the idea? So we care about how much we invested in it and then what we sell it for. So we're just going to call it investment in what? Held to maturity bonds. If we do not hold them to the end, held to maturity means the end of the 10 years in this case, right? If we don't hold it to the end, and that's a debit. Sorry about that. This is the debit, that's a credit. Obviously, I should have put the credit over a little bit, huh? So debit investment in held to maturity bonds and credit cash. Everybody got the idea? okay? We're going to hold it to maturity, and if we're not going to hold it to maturity, it would be a different type of investment called an available for sale or trading security, and we'll worry about that when we do Appendix E, okay? Fairly soon, okay? Got the idea? Okay, so then what happens? And by the way, I'd show that where on my balance sheet if I had the investment. Held to maturity, 10 years, come on, where does it go? Non-current assets, right? Absolutely. Be down we might have investments or we might have other assets or something, right? Down after property, plant, and equipment typically. Got it? Okay? Depends on what's going to last what period. So then what's going to happen? 6 months goes by, guys. 6 months goes by. What do you think? Guess what happens? Look at the bond. What happens on that bond? Every 6 months, what happens? There is going to be interest of how much paid? Somebody said it. How much is it? $4,000. Everybody agree? What do you bet? And remember what the interest rate is. The interest being paid is $4,000. That's 4% of the face amount, right? But what interest rate's being earned here and therefore paid? What do we discount at, everybody? 5%. If I discount at 5%, do you think it'd be a good idea to compound about 5% at 5%? Discount at 5, compound at 5, you'll unravel the deal. That's all that happens. A common mistake is people will discount at 5 in an example like this, and then they'll compound at 4 and everything just goes nuts. Okay? So keep it straight, right? What's the 4% for here? The stated rate for 8% a year, 4% for half a year. What's that for? Determine the cash flow. What's the 10% for? The effective or market or yield rate? In this case, it's 10%, 5% twice a year. What's that for? Discounting and then compounding, right, to unravel it, to compute how much interest we actually incurred, interest expense. And we know what the interest paid is. It's $4,000. Okay? So now let's try a journal entry. Okay? Let yourself just pound on this until it just makes sense. Do a bunch of examples. Okay, tell me this. If I borrowed the money, how much cash do I get? Or I'm sorry, how much cash do I pay out? Let's hope the borrower pays the interest, right? I borrowed the money, right? I have bond payable of 100, right? Discounted on it of 12,462. So the amount I really borrowed was 87,538. It is, right? Everybody agree that's how much cash you got? Okay. Am I going to pay the interest or receive the interest? I borrowed. I'm going to pay. So what's going to happen to my cash? I bet you credited for 4,000. Everybody agree with that? What's going to happen to the people, the investor, that loaned the money? They're going to debit cash. Absolutely. That's exactly what happens. So do the easy part first. Why not? Okay, now why are they giving me cash? Or I'm sorry, why am I paying them cash? Let's do the lender first. I'm paying them cash. Why? Because I borrowed money, time went by, and I owe them interest. And what's that to me? Interest what, guys? Yes, interest expense. And how do you increase the expenses, all of them? With a debit, yeah. See, the thing on this chapter, it's pretty hard, but it's all one big problem, okay? Just one big thing. Guess what? If I lent the money, right, I'm the investor, I get cash. And why did they give me cash? Because I earned interest revenue. Yeah. And how do you increase revenue accounts, you guys? Credit. Yeah. We got it. Interest revenue. Okay? All we have to do is figure out how much interest revenue it is. How will you do that? Take a look at this one. How are you going to find out how much of that 4,000 is interest revenue? How much was borrowed, everybody? 87,538. Excellent. It's 87,538, isn't it? 87,538 was borrowed. How much was lent? 8. No. They're going to pay 100 at the end, right? The investor's going to receive 100 at the end if they hold it the whole time, right? And the borrower is going to pay 100 at the end. But how much was borrowed? 87,538. So how much was lent? 87,538, right? It's 87,538 on both sides. Everybody agree with that? It is, isn't it? Okay? So the interest is going to be the same on both sides. That makes sense? So that makes it easier. What's the interest rate? 5% every 6 months. You got it, right? 5%. So we're only doing 6 months, right? That's June 30th. Take 5% times it. I'm not kidding. And you're there. Okay? What's 87,538 times 5%? 0.05.
4376.9.
So we'll round it, okay? In real life, you wouldn't, of course, right? Okay, so 4377. Everybody good? Guess what the interest expense is? Yeah, okay. Guess what the interest revenue is? Yeah. So you look at this, when you're reading what the author's doing, it's like, oh my gosh, right? But we cut right through it, and it's good to read that, of course, so you know what's going on. But, you know, once we cut through it, we look at what's really happening here. It's not so bad, is it? It's not bad. Do it a few times, right? You'll get it. Okay, so what do I need? Another credit over here, 377? Would you guys agree with that? What do I need over here? On the borrower side, I need a 377 credit to make the journal entry balance. What do I need on the investor side? Debit. Okay, what's it going to be on the borrower side? What do we have that represents the additional interest? See, they're only paying $4,000 interest right now. Every time they're only paying $4,000, but the expense is more. When are they going to pay that extra $337? At the end of the bond, they're going to pay off $100 when they only borrowed $87. Got it? That's it. Okay? So we did that right, didn't we? I hope. Okay? It's going to be 20 times. So it's going to come up to $12,462 by the time we're done. Okay? It is. We're going to get rid of that whole discount. Oh, we're amortizing this discount, you guys. That's all we're doing. So take a look at that. We've got bond payable with $100,000 in it, right? That's our bond payable there. And we got discount on bonds payable, which is the contra account that goes with it. Started with how much?
12.
Yeah. And what did we just do to it? Whoops, that's a debit. Sorry. 12,462 debit. It's that debit right here. Everybody see it? Okay. Bond payable there. It's kind of bonds payable. So what's 100 less 12,462, of course? It's the 87,538 beginning carrying value, right? Okay. Then what happens when we credit that 377? Oh, we're getting rid of the discount over the 20 payments. That's all that's happening. We're putting it into interest expense because that's what it's going to be, right? Okay. So my real interest, this is called the effective interest method. By the way, in the chapter, they have a straight line method, right? Nobody on earth uses that. It's only in textbooks because it's easier. You think it's really easier or just ridiculous to add it in there? You guys can handle this, right? You can calculate interest, okay? It's not a big deal, okay? I don't know why they do that. So what is 12,462 less 377?
12,085.
What's my new carrying value on the debt? It's no longer 87,538. What is it now, everybody? What do you think? It's 100 less 12,085, isn't it? It is, right? What's the difference between those two? What's that? That's going to be for my next interest payment. Ah, how much? 87.
915.
87,538, yeah, plus 377, 87 what? 915? Yeah, okay, great. All right, that's going to be next time. That's just the difference between those two, right? Let's do the other side. Let's take a look at what would happen for the investor. What are they going to debit? Now, what they debit is investment in held-to-maturity bonds, because the bonds are on the books at 87,538. What do you want them to be by the end of the term? So here I got this investment in held-to-maturity bonds. In that account, I have 87,538, right, guys? What is it going to grow to by the end of the term? Well, how much are you going to get paid at the end of the term? 100,000. I want it to be 100,000 when I get paid. That's it. What do I want the discount to be at the end of the term? When I get paid off the 100? 0. How? So I amortize the discount in both cases. It's just that I have a discount account here, right? Here I don't have a discount account, so what am I going to be increasing every time? What do I want to bring up to $100,000 by the end? Investment in held-to-maturity bonds, right? So what do? Debit it. That's it. It still is the discount. It's just the discount is buried in that investment account. Got it? And that looks funny at first. So here on the investment side, the discount is included in investment in held-to-maturity bonds, right? It's going to be 100 at the end. So I just bring it up, okay, over time. Over on the other side, on the borrower side, I actually have a discount account, okay? So I'll amortize the discount away over time. Does that make any sense? Okay. Let's do the second. Oh, by the way, what's their carrying value now? If they debit investment held to maturity bonds for 377, what do they have in there now? What's that? What's 87,538 plus 377? It's a miracle. 87,915. It is, isn't it? Everybody see that? It's the same number on both sides. Well, of course it is, right? One person has the debt, the other has the investment. It's got to be the same amount. Okay, now what? Let's do the next one. You guys try and do the next one for me. Do the interest. This was the interest payment at June 30th. Do the one at December 31st. Okay? So now we're out at the end of the first year. Do the interest payment. So that's the second one. Second payment, right? Cash is going to be exactly the same. You're still going to have interest expense or interest revenue. You're still going to amortize the discount. No big deal. I know you can do this. After I beat you up on test after test, quiz after quiz, maintain your confidence, okay? Believe in yourself. Make it happen. Those are the people we want to hire. The ones who screw everything up, as everybody does, and they keep on working and get it right. That's who we want. Everything gets screwed up. But things are complex. Outside if you're looking for the cure for cancer, how many times you fail? Keep going, right? They're brilliant people. Keep going. And they get breakthroughs. Sometimes. Towards a successful position. A lot of people say, yeah, right.
You almost around with yourself, right?
Yeah, just round with yourself. Everybody do it? Does everybody know it's exactly the same journal entry? It is, right? What do we want to do? It always bounce around so much. What do we want to debit? If you're the borrower. Interest expense. Every time. We're going to do this 20 times, guys, in the life of this bond. What do we want to credit? And discount and bonds paid. Absolutely. How much is the cash every single time? All 20 of them. It's $4,000. Okay, let's do the investor side. What are they going to debit? How much? 4,000. I'm going to give you points for this. Lots of them. Credit what? Interest revenue, of course, right? Okay, and then what are we going to have? Investment, because we're getting rid of the discount by increasing the investment held in maturity bonds. Absolutely. By the way, if it was a premium, it'd look different, right? We'll do a premium in the little review session we do today, okay? And then we'll do it again tomorrow, day after tomorrow. Then in another review session, maybe, if you want to have one. Got it, okay? So we do them all, okay? Before you have to do a quiz. Bad enough the quiz is right. Okay, so how much interest? What are you going to do?
4,396.
Where'd you get 4,396?
85% of 87.
Yeah, here's the carrying value in both cases, right? 87,915. So if the carrying value is 87,915, that's how much is now borrowed, right? The way to think about it is you borrowed the interest you didn't pay. That makes sense? You borrowed another $377. That's all that's happening, okay? So now it's 5% of that. So guess what? The interest is slightly more. How much was it?
336.
4396. So see, it's a little more than the 4377. Everybody agree? So what's the interest expense? 4396. What's the interest revenue? How much are we going to credit discount on bonds payable for? Always make your debits equal your credits, gang. Good idea, right? You like that? Okay, fine. And then how much you want to debit investment held to maturity bonds for? Okay, I want you to do one more thing and I'll let you out of here. We'll even leave a minute early, maybe 2 minutes early. Have we ever done that? Might be the first time. We left 5 minutes early once.
We were 5 minutes past the time.
Oh, past always, I know, yeah. So I'm going to give you back a minute of your life. Okay, so here's the deal. What's that? Counting is my life. Yeah, good. Okay. All right. So, oh, that's sad. I hope you have more than that. You might get rich, but it's still sad. I'd like you guys to show me what the entry is on the very last day of this thing. And assume we've already recorded all the interest payments, therefore all the interest expense, and we've amortized the discount, of course, right? Ask yourself, what will be the carrying value in investment held to maturity bonds? And what will be the carrying value of the bond payable less the discount? And then what will happen at the end? So at the end, right, the bond's due, it gets paid. This journal entry is very simple. I'll give you this on a test quiz or final somewhere. At the end, at the very end, so we've already done the interest. You don't have to mess with the last payment of interest, because it would be a pain to figure out what that is. I don't want a spreadsheet to do it in Excel, then it's easy. Okay? But anyway, give me that ending journal entry. What happens at the end? What happens to the borrower at the end? Write down a debit and a credit. There's just one debit and one credit. What happens to the investor at the end? It's real simple. You don't have to compute anything even. There's no calculation there. What is the carrying value of the bond after you amortize the discount? Discount will be 0. The bond payable is $100,000. What's the carrying value? $100,000. How much is going to be paid? $100,000. Make the entry. On the investment side, what's the carrying value of the investment going to be if you keep increasing it until you hit $100,000? It's going to be $100,000. And what's going to happen? You get paid. That's what we're doing here. Maybe it'll make that solid for you. So here we go. I want you to leave early. What's going to happen to the people that are paying off the bond? What are they going to pay it with? Cash, credit cash, $100,000. Everybody agree? And what are they going to debit? Seeing as the discount's gone, which it is, of course, right? Bond payable. Sure, it's just paying off a liability, just like accounts payable or something. Absolutely. That's at the end. Retired the bond. What's going to happen to the people that invested in it? I bet they get the cash. How about debit cash, $100,000? And how about credit what? Not bond. No, we don't have a bond receivable. Don't call it that. We call it a investment. I know it's kind of a bond receivable, but it's not really. It's an investment bond, okay? We call it an investment in a bond payable. It's really a long-term investment versus a receivable. Okay, we're earning interest off of it. Ta-da! And then we're done. 0 and everything, huh? How much interest will we have recognized? How much interest? We will have recognized the difference between the $87,538 that was paid to the bond, right? And the $180,000 that was paid back, right? Interest and principal. See you guys. Don't turn me in for letting you leave a minute late. Oh, well, sorry. Yeah, I think it is. It's either right here near the door. One of them is before yeah, 4 to 5 today, you guys, if you can make it. And I'll record it, and then we'll see what we want to do on a Friday, too. If people want, we will. Okay? He's working day, or Wednesday, rather, yeah. Friday's too late, right? Yeah, Wednesday. Wednesday on Friday.
I don't know what day it is.
I'm not changing my.
I spent all day yesterday with my grandson. I'm really sore. He beat the crap out of me. He's 6.
I
Oh,
can see
man.
where my
He hit me right here in the sternum.
my answers.
Really wet nailed me. With his fist. too.
None of my
Yeah.
skin
Perfect.
changes would have changed. Like, none of my skin changes changed a thing.
I'm lucky the other ones are girls. Not quite as mean.
You look. Wow. So sweet. Walking stereotype.